Good morning, everyone. My name is Meet Panchal, and I'm Janki Mistry Ma'am student. I'm going to be teaching you all financial reporting, that is FR. In case of financial reporting, you're going to come across the understanding, you'll get a knowledge and skill of understanding and applying IAS and IFRS, that is India International Financial Reporting Standards and International Accounting Standards. We are going to come across both of these standards in different chapters. So today we are going to be doing foreign currency, chapter 10. In case of foreign currency, the basic understanding is of exchange rates. Okay, so when we are trading with foreign countries or we are having trade relations with such foreign countries, we are going to have a problem of exchange rates, right? So for example, if I'm purchasing a commodity from US, so if I'm purchasing on credit, and today if the exchange rate is 70 rupees for $1, and I'm going to be paying after 3 months. But after 3 months, the exchange rate changes to $72, 72 rupees for $1. So I have to pay more, okay? Because I had to pay only 70 rupees when I actually had the initial transaction, but the settlement date, it was 72 rupees. So I have to have a loss now. So that is what how we are supposed to deal with the exchange rates in case of foreign currency. We're going to come across IAS 21 in this chapter, that is the effects of changes in foreign exchange rates. That is what I explained here, the effects of the changes in foreign exchange rates. There's going to be an initial treatment, settled transactions and unsettled transactions. Okay, and also there are certain definitions mentioned here. There is one historic rate, one closing rate, and one average rate. Now, what is historic rate? Rate in place at the date the transaction takes place, sometimes referred to as the spot rate. Okay, so when I actually started the transaction, that is my initial transaction of purchasing the commodity, the rate on that date is known as my spot rate or historic rate. For example, if I purchased a commodity on 1st April for 70 rupees is to $1 was the exchange rate on that date, then that is my historic rate or spot rate. Now, what is closing rate? Now, after 3 months, if I make the payment for that commodity which I purchased, so on that date, whatever the exchange rate will be, that is my closing rate or the rate at the reporting date. And average rate is the rate which is constant, which is average throughout the accounting period. Okay. Um, then there is assets and liabilities. In case of assets and liabilities, there is monetary items and also there is non-monetary items. Now, what are monetary items? Monetary items are such in nature which can be easily convertible into cash. Okay, and unlike monetary items, non-monetary items are such which cannot be easily converted into cash. Okay, examples of monetary items would be receivables, payables, and loans and such. And examples of non-monetary items are which cannot be converted into cash. So that would be plant and machinery, inventory, etc. Okay. Then we are going to be talking about currency. Okay. What is functional currency and what is presentation currency? The currency of the primary economic environment in which an entity operates. This will usually be the currency in which the majority of the entity's transaction takes place. Okay, so for example, if I have a company, okay, Indian company, and I'm trading with US, so I have a company which operates from India, and I am actually selling something, and whatever I'll receive for it, or if I'm paying something, whatever I'll have to give for it will be converted into Indian rupees, and Indian rupees will be my functional currency because I'm a company trading operating in India. Okay, then the presentation currency. Now I have to prepare the financial statements. So for the preparation of financial statements, whatsoever currency is used will be the presentation currency. Okay, so here they're just explaining that how it influences the sales prices for goods and services, the currency of the country whose competitive forces and regulations mainly determine the sale price of goods and services, the currency that mainly influences labor, material. So the Indian rupees, if I'm a company cooperated in India, okay, so Indian rupees is my functional currency, and whatever will be the labor, material, or whatsoever costs related to the transaction will be in Indian rupees. Okay. Or has to be converted into Indian rupees. Then individual company translating transactions. Okay, so first is the initial transaction. As I told you all, me purchasing a commodity on credit from US or from any other country, maybe UK or any other country. The first transaction is me purchasing the commodity. So that is my initial transaction. Now translate using the historic rate prevailing at the transaction date. So what is the rate that is supposed to be used? Historic rate, that we also read it earlier, that historic rate is the rate at the date of initial transaction. The average rate can also be used if it does not fluctuate significantly during the accounting period. Okay, so if it does not fluctuate during the whole accounting period, you can use the average rate in case of the historic rate is not mentioned, but it is preferable to use the historic rate. Settled transactions. If a transaction is settled, a payment or receipt occurs during the accounting period. Translate at the date of payment. As this may be different with the initial transaction, an exchange difference may arise. This is posted to the statement of profit and loss. Okay, so in case of settled transaction during the accounting period, see, for example, my accounting period ends on 31st March. Okay, my company's accounting period ends on 31st March, and I am actually purchasing a commodity on December and making a payment after 2 months. Okay, so I am purchasing the commodity and also clearing the settlement before the end of the accounting period. So here I'm clearing the settlement before the accounting period. So the transaction in total is settled. Okay, there is nothing left for the next year, for the next accounting period. So everything is settled. Then translate at the date of payment receipt using the historic rate. So you have to use the historic rate in such case. And afterwards, if there is any statement of profit and loss, like for example, if I chose to have the historic rate, but now on the date of settlement the exchange rates have changed, so there would be some gain or loss obtained from it. That gain or loss shall be transferred to statement of profit or loss. Okay, so for getting a better understanding of this theory, we shall solve a sum. Okay, so let's solve a sum. I would also like you all to have your question in hand so that we can solve it simultaneously. Okay, so let's just read the first sum, shall we? Now, what is the first sum mentioning? On 1st April 2008, Collins Company, a company that uses dollar as its functional currency, buys goods from an overseas supplier who uses cromets as its functional currency. Okay, so what is my functional currency? Here, the goods are priced at KR 54,000. Payment is made 2 months later on 31st May 2008. The prevailing exchange rates are 1st April, Cromet is 1.80 for $1, and on 31st May it is 1.75 for $1. So as you can see, my $1 is constant here, and the value in Cromets for that dollar is changing. So my dollar is my functional currency. Okay. And they've already mentioned at the start that a company that uses the dollar as its functional currency buys goods. Okay, so dollar is my functional currency. Now, the first basic entry, as I'm purchasing a commodity, will be purchases to cash. But since the cash has not been paid yet, it will be to payables. Okay, and now for calculating the amount, it is given in Cromets 54,000, right? So you have to convert it into dollars, right? So for dollars on 1st April, this is the entry on 1st April, right? So this is for April. Okay, so what will be the entry on 1st April? Purchases to payables, and the amount will be 54,000. Okay, so it will be 54,000 divided by the value of dollars in cromets, because this amount is also in cromets, 54,000 cromets. So 54,000 divided by the value of dollars in cromets. So that will be 54,000 divided by 1.80, and you will get your answer 30,000.